Hello and welcome. My name is Mike Bernard. I'm one of the certified financial planners here at Korhorn Financial Group on a great team of CFPs. I'm also the host of the Wise Money Show and help with all of that content there. So if you haven't checked out the Wise Money Show, I'd encourage you to do so. A lot of our latest thinking on the investment world and different financial planning concepts are kind of thrown through that medium. So go check that out online, wisemoneyshow.com, and then the YouTube channel and radio and all of that sort of stuff. So check that out. But thanks for spending a few moments with us today as we dive into what happened in the markets in 2021, look under the hood of actually what happened, and then kind of talk through what is likely ahead for 2022. And you can't think about this year in the markets without also thinking these are just strange times. This is just a strange environment to be in. And certainly the stock market had that strange time as well. Some calm, but some chaos as well. Some like we're out of the woods, and then the next is, can this really be sustained? So we're going to get into that and what's going on in the investing world. Really, let's start with what drove the markets in 2021. And it's impossible to talk about the drivers of the market in 2021 without really starting and finishing with the Fed. The Federal Reserve is sort of the puppet master, kind of orchestrating all of this. And some would say their manipulation or involvement was too much. I might be in that camp, okay? But they played an enormous role in what happened in the economy and the markets in 2021. Now, we can look back on it now, but doing so, actually in hindsight, if you would have said, hey, the Fed was going to keep printing money, keep injecting money all year, they were going to keep interest rates at record lows, and that we weren't going to have another shutdown, another sort of huge outbreak and all of that, that the economy would continue to roll on, in hindsight, or if you would have told me that was going to happen, I'd said, yeah, it probably would be a pretty good year for stocks. And it certainly was for the S&P 500, a fantastic year in the market, really from those characteristics, the Federal Reserve printing money, keeping interest rates low, and the fact that the economy was able to stay open. Corporations had record high profits, record high profit margin, never been had before at this high level on the S&P 500. Now, those same things that drove the market, and I would say in a positive way, created some negative ramifications as well. And we're going to go a little bit deeper into those because we're a bit cautious about the market at this point. And the very first reason would be dangerously high valuations. I just can't tell you how many times I looked at a chart throughout 2021 where it said, this hasn't happened since 99, or this hasn't happened since the tech bubble. One of those is the price to earnings ratio. Okay. And this speaks to that valuation and having them be dangerously high. Now, the price of the stock or the price of the stock market compared to the profits or the earnings, which I told you are at record levels. That's the PE ratio. That's the price to earnings ratio. And you can see here on this chart, overly complicated, but this current level of these price to earnings ratio, what you're having to pay in price for a dollar's worth of earnings today is second highest only to that tech bubble. Only to that tech bubble. You can see it's come down a little bit throughout this year. That's fantastic. Hopefully the economy grows into it. But dangerously high valuations. The market is high. Another way of looking at the price to earnings ratio is with the Shiller PE. Now, this is the same sort of calculation, except that it is averaged, so the earnings are smoothed out to eliminate some distortions, and it's also adjusted for inflation. Many believe that this is a truer picture of the actual PE and the valuation of the markets, and you can see here, again, second highest on record, close to that peak of the tech bubble. Now, to me, while I'm cautious and aware of the PE ratio, the ratio that scares me more about valuations is the price to sales, okay? The price to sales. So this is the price of the stock market or the S&P 500 compared to the revenue of these companies. Now, earnings, it's revenue minus expenses equals those earnings. Earnings can be manipulated in some way, okay? You can choose to not take this accounting deduction here or take it in a certain way. You've got some creativity. There's no creativity with revenue. You either had revenue or you didn't. And we are at record high levels in the price of the stock market for the revenue that's being produced right now. This is, far higher than it was even during the tech bubble. So this is alarming and pointing to dangerously high valuations. And then the last one that I'll share is termed kind of the Buffett ratio. It's how big is the stock market compared to the GDP. So how big is the stock market compared to the economy? Okay, the stock market and the economy, those are two separate things. They are connected, but they're two separate things. So comparing the stock market to the GDP, you can see here that last year we reached all-time high levels. The highest it's ever been was during that tech bubble, and we surpassed that level in 2021. So to us, yes, the Federal Reserve and keeping interest rates low and these record high profit margins have created a few different dangerous outcomes, and one being record high valuations. But the next that I'll point out is a top-heavy market and deteriorating market breadth. Now, what does that mean? I'll explain in just a minute. When you look at the S&P 500, that's the 500 largest companies in the United States. It's never been more concentrated than it is at this moment. So these 500 companies, they're not all equally weighted within the stock market index. The largest companies get a larger proportion of the overall index. So Apple, as a $3 trillion company, is going to take up more weight of the S&P 500 than, let's say, Bed Bath & Beyond or something like that, right? And so the stock market has never been more concentrated than it is right now. Take a look at this. The 10 largest companies in the S&P 500 make up 30% of the entire stock market. That is astounding. And once again, as I warned you before, hasn't ever, this is the highest level, hasn't been this high since 2000 in the tech bubble. We're even surpassed that point. Now, that's the largest 10 companies. If we isolate a few of those, they're called the FANG M. So this is Facebook, Apple, Amazon, Google, Netflix, and Microsoft. Take a look over the past few years how just those handful of companies, this isn't even including Tesla, guys, which is now in the top 10 of the S&P 500, just a few months after being added to the index. Look at how the FANG M has performed over the last few years, specifically over the past year or two, and how that's just dragged the market higher. Why do we worry about, or why do I point out this concentration? It just makes the market as a whole more fragile, okay? And that fragility was definitely on display in 2021. Not necessarily because of these stocks, but because of market breadth, okay? So market breadth, we haven't had to worry about since 99, since 98, since the tech bubble. And what it means is when the overall stock market index is going in one direction, how many of the actual companies within the index are going in that same direction, okay? Typically, you'd say, well, most of them, right? Or almost all of them. Yes, that is normally the case. Not right now. There's been spikes throughout all 21 and even to start this year where the index is going one direction, but the average company is going a different direction, okay? And so this happened a lot in the NASDAQ, happened a lot in small caps. We saw it some in the S&P 500, but we also saw it even on the New York Stock Exchange. Take a look at this, yes, look at the headline, December 1999, based on the New York Stock Exchange shares. The S&P 500 closed at a 52-week high, while 334 of the companies traded on the stock exchange hit a low for the year. So while the index or the market was hitting an all-time high, 354 companies were hitting new lows. Only happened 3 other times in history, all of them December of 99. And then lastly, okay, so that's one of the areas of caution that have come out of these market drivers. And the other one, obviously, coming directly out of the Fed and some of these other drivers, has been inflation, okay? And we all know that inflation is real now. The Fed told us it was transitory and it was temporary and it wasn't really persistent. It's persistent. It's a problem. It's there. You see, we're now at the second highest or the highest level of inflation since the hyperinflationary time periods of the late 70s and early 80s. And so, over 6% inflation, that's a staggering number. We're all feeling it. People are pointing fingers and the Fed is trying to figure out, well, what do they need to do? What could they do to help That's going to be a theme for 2022. I'll just forewarn you. But there's no mystery. There's no mystery as to why we have inflation. Inflation, in a very crude definition, is when you have too much money chasing after too few of goods. Well, we've had too few of goods thanks to the shutdown, supply chain issues, and labor shortages, and there's been way excess in money. Now, you might say, I'm not feeling like I've got a lot of extra money lying around. Yeah, the Federal Reserve has printed it on their balance sheet, expanded by nearly $5 trillion. And much of that money is not landing in your pockets. It's landing in the financial system, pushing prices up and causing inflation, causing a big problem. So what's driven the market thus far this year? Some very strong tailwinds like the Fed. I can't point out a bigger tailwind than the Fed, but we've got those tailwinds have created some serious headwinds and risks as well. All right, so how did that translate to the stock market? How'd the market do in 2021? And most notably, the S&P 500 is a fantastic year for the S&P 500 index. You can see it on the screen here. That's as straight of a line as the S&P 500 can move, up nearly 28%. We saw a big drop. Basically from September 1st to September 30th, it went straight down, and then that was all recovered in October, November, some jitters in December, but overall, fantastic year for the S&P 500. You've heard that, you've felt that. However, that didn't translate over to all major investment categories. Take a look here at small caps. This is the Russell 2000 index. You can see here that the Russell 2000, I kept the S&P 500 in light blue there so you can see it for comparison. Small caps, the Russell 2000, significantly outperformed large caps to start the year, up 20%, while the S&P 500 was only up a couple, and then flatlined. Gave it all back and flatlined to then spike in November and drop significantly to end the year. Guys, this is an indication. This is sort of revealing of some of that market breadth issue where the veneer looks great and strong, but there's fractures beneath the surface. It wasn't just small cap. Another big area that investors have dollars are international markets. You can see here in purple that international markets kept up with the S&P 500 halfway through the year. I mean, up through June, the international markets were right there, and then with a little pullback in the S&P 500, international stocks had a big pullback, flatlined, and then negative to finish the year as well, up only 8.5%. In stocks, really, the area of greatest weakness was emerging markets. Once again, outpacing the stock market to start the year, and then that little drop in the S&P 500 in late February was a big drop in emerging markets, and then that drop just continued through the rest of the year. Emerging markets finished negative. Bond markets, though, were the problem. And for those of you that are diversified, which of course you are, likely you've got some dollars in bonds. If you're closer to retirement, you might have 40% or half of your money even in the bond market. And unfortunately, the bond market just got out of the gate struggling and just never recovered. It was a negative year in the bond market. And you'll see in just a moment, only the fourth time ever since the bond market was in existence that it was negative. When interest rates are rising, bond investments tend to fall. And even though the Federal Reserve kept interest rates low, out in the open market, interest rates were fluctuating all year, and that caused bonds to underperform. So in the reality, this year was a great year for the S&P 500 index. By the way, 70 all-time highs in the S&P 500 created last year in 2021. Second only to, you guessed it, the tech bubble. The highest was 1997 at 77 all-time highs. But outside of that, most other large asset categories struggled. Even though the stock market, the S&P 500, had a fairly smooth ride, lots of choppiness and sharp volatility in those other areas. And as I mentioned, negative year for bonds. Disappointing year for bonds, fourth time ever in 4 decades that index was negative. So how does all that translate for your KFG investments, the KFG investment models that we manage for you here? Well, you know that we believe in diversification, but it's not just normal diversification of the asset categories, the asset classes, because diversification is about trying to not have all your eggs in one basket. And that means not all investments moving in the same direction at the same time, which normal diversification during extreme market environments they can all move in the same direction at the same time. We saw that in 2000. We saw that in 08. We saw that in 2020, right? So normal diversification doesn't cut it. You've got to diversify your investment strategies as well, which is what we offer here at KFG. You know that to be our strategic and core models, which is more pick a recipe and follow it, riding through the ups and downs of the market. This strategy is more of on an index type chassis, and we'll track that well. Plus a dynamic model, which is a momentum-based system, trend following model that analyzes what areas of the market have had momentum and looking to overweight to those areas. I mentioned trend following. There's no system, there's no perfect system out there that can see around corners, picking a top or picking bottoms. Instead, momentum reacts to existing trends. Now, markets are moving each and every day, but momentum tends not to shift that often, taking a few weeks to adapt. Therefore, a violent, choppy market that moves just steep enough or just long enough to suggest a new trend, then only to reverse, is the most challenging environment for dynamic. And unfortunately, that certainly was the case in markets in 2021. Now, the benefit of using this multi-strategy approach, having a core strategic model plus a dynamic model, allows you to stay grounded, holding all areas of the market because you have exposure to them in core and strategic, but then complementing that with an adaptive strategy that can overweight to stocks when they're doing well, pivot to bonds or real estate or other areas if needed, even shift and hold cash at times when nothing appears to be working. Strategic held up extremely well. Core capturing the returns of the market because index funds are the backbone of core and strategic, so they did fantastic. Our active bond funds, including inflation-protected bond funds, were advantageous, helped outperform during a negative and trailing year in the bond market. So that was fantastic. And then within strategic specifically, we hold a few funds that tilt, and that helped provide outperformance in stocks. So all around between core and strategic, fantastic year. Dynamic, though, it was just a challenging year all around. It was a very challenging environment for dynamic, where in 2020 there was clear direction. The market worked, it didn't, and now it did. It was very clear for dynamic to make the appropriate adjustment at the right time. 2021 was the exact opposite. We always say that the Achilles heel for a momentum trading, a trend following, a dynamic type system are short, choppy trends. And that was ever present in 2021. I'll show you a few different scenarios here in just a second where that was very much the case. But that was a very challenging time period and an environment for the dynamic stock system, and deteriorating market breadth that all of a sudden appeared out of nowhere created, again, this choppy environment that was very challenging for our dynamic models. Let's get into a couple of the particulars within dynamic, these choppy time periods that made it tricky. Now, looking at 2020, okay, what's on the screen right now, this is 2020. This is small caps, the Russell 2000 index. And you can see when the economy shut down, the market dropped and fall. Small caps did as well, the recovery yet. But look at that last quarter, the last section of the year where small caps, the Russell 2000, just outpaced the stock market significantly. You might remember this was the best month that small cap stocks have ever had, one of the best quarters they've ever had as well. Well, dynamic had a lot of exposure, had some exposure in small caps as well. And to start 2021, that was advantageous. Take a look here, that up nearly 20% in the first couple of months, outpacing the stock market significantly, more than double. Well, if I pull the sheet away here, now you can see some of that choppy experience that is just so detrimental, so challenging for a momentum system. We had a pullback, a significant pullback. Each of these, about 1, 2, maybe 3 week pullbacks, all of them 10 to 15%. So very sharp, very frequent, with a frequent rebound as well. Very challenging. That is the definition of a challenging environment for a momentum trading system. Even more so, our dynamic models have ridden the wave of growth in tech significantly, okay? And here's one example. This is the Morgan Stanley Institutional Fund. In 2020, look at this fund. The total performance, it was up over 115% in 2020, making it one of the best funds anyone could own, and we held it the majority of 2020. Look at how it outpaced the S&P 500. And to start 2021, the same, up nearly just about 20% through the first 7 weeks or so of the year, far outpacing that of the S&P 500. But just like with small caps, but even to a greater degree, when I pull the sheet away, there are extreme, sharp drops. That was not only present in this particular fund, but large cap growth in particular. If you take a look at that spring time period, our dynamic stock models were outperforming significantly for the first couple of months. And then that choppy time period that we saw here, within just 2 weeks, a drop of nearly 25%, then a recovery, then a drop within another 2 weeks of another 20%, happened in large tech, large growth, and small caps. Very challenging environment for Dynamic. And Dynamic recovered and did well during the summer months, but then at the end of the year, something similar occurred. Lots of choppiness, short choppy trades created just a challenging environment for the Dynamic models. A bright spot in our dynamic models in 2021 was in the area of bonds, where the bond market underperformed all year. Our dynamic bond models made allocation adjustments fantastically and outperformed the slumping bond markets, providing positive returns in all of our dynamic bond models. Now, despite the challenging, choppy environment that existed for dynamic in 2021, right now, stock valuations being at these elevated levels and the Federal Reserve shifting their monetary policy suggests it's extremely prudent right now to have this dual strategy approach, having a strategy that can adapt to changing market conditions. In fact, the first 2 weeks of 2022 have been off to an extremely rocky start as markets have concerns about what the Fed's doing. The Fed actually suggested they weren't just going to be increasing interest rates or slowing down how much money they print. They actually mentioned about starting to pull money out of the economy, trying to slow down the economy. It could be a very volatile year, and that way, having a multi-strategy approach could be very important. Now, on the bond side, same thing. If interest rates do continue to rise, inflation stays at these high levels, if the Fed overreacts, overcorrects, something like that, it could be another challenging year for bonds. Therefore, having a multi-strategy approach still does make a lot of sense as well. So what will the drivers be for the market for 2022? I mean, there's significant tailwinds, but those tailwinds, again, have created some headwinds as well. It likely could be a challenging year in the market. What will drive it? What will the themes be? Well, the Federal Reserve, for sure, just like it had its hand all over the market in 2021, it certainly will in 2022. Specifically, how will the Fed deal with inflation? Likely that will cause a market reaction. Either if they handle it well or if they handle it poorly, it's going to drive the markets. Inflation is here. They've printed enough money to make sure that that's the case, okay? So how will the Fed do it? Will they increase interest rates rapidly more than they want to? Will they surprise the markets in that way? Or will they surprise the markets on the positive? Will they start pulling money out of the economy? All of this is going to drive significantly what happens in the markets. With valuations being at dangerous levels, can the economy continue to grow into it? Or will inflation put a damper on corporate profits, these record profits that, by the way, Wall Street's expecting will continue at record-setting paces? And will these valuations actually turn out to be dangerous, or like I said, will the economy grow into them? So those are likely the driving themes for the upcoming year. What steps do you need to be taking right now? Number one, you've got to make sure you're taking the right level of risk in your investments for your overall financial plan. I can't stress that enough. When valuations are at these high levels and the Fed is saying that they've got to start adjusting their monetary policy, now is the time for you to look at your risk. Tune into your financial plan. Make sure that your investment strategies are diversified so that you're diversified. Not all your eggs are in one basket as we enter into this season. Now's a great time to rebalance. That's what we're doing here for you for your dollars and accounts managed here at KFG. We do that automatically this time of year. But make sure that you're rebalancing the other investments you have, whether it's 401k or other dollars. And then lastly, I hope my words of caution about valuations and Fed decisions don't alarm you, because really you still need to be investing to keep up with inflation over long periods of time. The only investment or the primary investment or place to put money that has outpaced inflation handedly over time is stocks, okay? So make sure that you're continuing to invest for the long term to outpace inflation because it's here. Inflation is here. We'll see how they handle it. We'll see how long it persists, okay? But continue to invest in stocks. Just make sure you're taking the right level of risk. Now, you know that investment planning is just one of the 6 areas of your overall financial life. While we've focused on it in today's discussion, you've got to make sure the decisions that you make within your investments are connected to the other 5 areas of your financial life, bringing synergy. This is why we always recommend that the strategies you use, the risk you take, it's connected within your investments. It's connected to the other areas of your financial plan. So work with your CFP on that. Hopefully you've got a meeting already on the schedule with your financial planner. If not, certainly reach out to us soon. Tax planning, tax preparation, it's about at that season, guys. I don't want to alarm you. You'll hear from us soon as far as what the right process is, method for collecting your tax documents this year to accurately and planfully prepare your tax return for this upcoming season. So if you don't have your appointment scheduled, your next appointment, either for tax preparation or to sit down with your financial planner, we can't wait to hear from you. So reach out to us. If you have any questions, concerns about the markets, we are here for you as well. So don't hesitate to reach out. Thank you. Thank you for spending a few moments with us. Thank you for your trust and for your business. We appreciate you, and we look forward to seeing you soon. Thanks.